at IMI, but he was my colleague at the Reserve Bank of India, and then he he came into the academic side. So with this, what we are going to do today, we are going to follow a multi approach. I'm going to invite all the three speakers, starting with Mr. Kannan, to be followed with Mr. Sabnavis, and then Professor Ram, to speak for about 5 minutes as opening remarks. And then I would like to have their thoughts on some burning contemporary issues and asking them to draw upon the experience of the last 25 years. They've been into the banking all these years. And then we'll open up the floor for question answers in about 45 minutes. So with this, I would now invite Mr. Kannan to please make his opening remark.
Thank you, Dr. Singh, and my fellow panelists and all the listeners to this. 1991 is a watershed year for India, especially from the economic point of view. I still remember the 1st of July and the 3rd of July, 1991, when we had the two foreign exchange rupee devaluation. And I was very much in the thick of thing when I was in the dealing room. And in the morning, we had around 10% devaluation the first day, another 10% the third day. And virtually everyone was shocked. Prior to that, of course, with the new government having come in, we had the new reforms in the form of various liberalizations. Hitherto, we had a substantial license raj. Everything you need to go for license. And then in over a period of time, the de-licensings, the industries could be set up in different places. Of course, in stages, it has been liberalized. And today, of course, it's a far cry from what it was before 1991. Having said that, from the bank's point of view also, in addition to the foreign exchange, what do you call, sudden devaluation, subsequently, it became a free market in the sense, before 1991, we had a fixed rate. In the morning, in the evening, we had a small gap, what's called the floor in the top. And the rupee used to always move within that particular range. And it used to be what is called a managed rate every day by the Reserve Bank of India. Thereafter, in stages, by around 93, 94, they had completely delinked it from the Reserve Bank of India, and therefore the market participants could access foreign exchange in the market rather than go to the Reserve Bank of India when the rupee is to weaken substantially, or when it strengthens substantially, they should go and dump the dollars or the sterling pounds with the Reserve Bank of India. Combined with that, then we had the interest rate deregulation. Before that, we had the rates of interest also being totally dictated by the central bank and the government. In over a period of time, first the deposit rates were deregulated, and thereafter the savings bank rates were deregulated. Combined with it, what happened was then we had the DFIs, which are actually the mainstay of the setting up of the industries, and led by three institutions, mainly IDBI, ICICI, and IFCI. They should do the appraisal, and then almost 50 to 60% it should be taken up by these three institutions as and when they found any project viable. About 25 to 30% should be taken by three investing institutions called the UTI, LIC, and GIC. And about a very small percentage should be taken by the banks. Banks are primarily retail lenders in the form of MSMEs and agriculture, and bill financing and working capital financing, and a small 5 to 10%. A similar structure was also there in the states, where you had the IDCs and then subsequently the financial corporations. And therefore, again, the banks were not taking a very large stake, and they were limited to about 10 to 15%. So with the result, the appraisal skills were never developed much in the public sector banks. But with the removal of the facility for raising low-cost funds by the three institutions, after they were not permitted to used the SLR route, because all the bonds which were issued by them were all subject to being classified as a SLR. So all the bankers and all the institutions and anyone else who had money could invest in it and get it not only the government backing but also get facility of SLR. And believe me, those days SLR rates, SLR percentage was pretty high, almost 30-35%, and so on. So a large portion was also being parked with these institutions, and therefore they had 10-year funds and 15-year funds, which could enable them to actually finance these projects for long term at almost fixed rates. But with this facility being withdrawn, so the entire mantle fell on the banks, and the SLR requirements also came down. With the result, they had a lot more substantial funds available. So banks did venture into infrastructure and core banking, core sector financing. And as Dr. And others also said, they had some experience of project financing for small amounts of, say, 5 crores and 10 crores and 20 crores, but suddenly faced with 500 crores and 1,000 crores and 2,000 crores, nowadays even 15,000 crores, they were slightly handicapped. And that, I think, is now being reflected in the spate of NPAs. Of course, there are other issues also as to why the financing failed, in addition to the equity not being coming, or the payments not being made, or regulatory approvals not coming on time. So I think the DFI's demise is partly responsible for the issues they face because of the non-availability of long-term funds. And the banks will normally get deposits, although technically they have a 10-year deposit. The only long-term funds they have got is only the Tier 1, Tier 2 bonds and the equity. And which is, and as you all know, the leverage of banks is around 9 to 10 or 11. And with the result, with that kind of leverage, I don't think so they had a large corpus of long-term funds. Therefore, they had this problem of mismatching funds, inadequacy of skills, and therefore we face these problems. They have, of course, have been doing a good job in the MSME sector. They have also started in the late 90s with the advent of the private sector banks, going into retail financing of personal funding. I remember till around 92, 93, we were very hesitatingly financing personal loans, car loans, and housing loans. And in fact, we were way behind HDFC or the other banks, even up to the end of the last century and also to the beginning of the century. But subsequently, having found that it is, though it is low margins, but delinquency being high, I think the being low, therefore it was a fantastic opportunity. And today, most of the public sector banks are offering fantastic rates. And as others say, it's not a very difficult proposition, because you don't look from the project angle, but you look from the repayment capacity of the individual or the persons. Therefore, that they went in a big way. And today, a substantial portion of the assets are in the personal segment and the retail segment. However, the corporate book is still pretty high. Unfortunately, all the corporate book is also held only by the banks in the form of loans, partly to do with the absence of a very deep bond market. Bond market today, on paper, exists, but mostly into AAA and to some extent AA category. And we have also seen the quality of the AAA papers and AA papers in the last few years. I think we don't have much to write home about. I think that's also something which is suspect. So we need to see how we can have a deeper bond market. Last but not the least, one of the issues which we faced in the project financing is the quality of the loans and the pricing of the loans. Whether it is a 10-year project or a 9-year project, whether it is called a 2-year gestation or a 3-year gestation, all of them had similar kind of interest rates. With the result, there's no incentive for the borrower or the promoter to complete it on time. And this is one area. And second is the bad bank. Bad bank, I think it's a good concept, but has its own limitations. How much are you going to fund? Who is going to bear the cost? Who is going to fund it? And if the bankers are willing to take a big haircut as they should, because they are, whatever they have touched is wrong. They might as well combine, sell it to one of the ARCs who would be in a position to fund it. But if they want it to be done only at the book value, I don't know who is going to fund the same. So these are my beginning thoughts. I think we have got a fantastic opportunity. It has always been good times for the banks, exciting times for the banks, right from 1991, as I told you, but exciting in different ways. We had exciting last year also. We had exciting 2016 also after the AQR, and we had exciting 2017 after the IBC came. We had an exciting 2020 with pandemic, and we are going to have an exciting 2021 post-pandemic. So I think we always have a exciting time. How we face it, let's see. Thank you, Dr. Singh.
Can I now request Mr. Madan Sabnavir for your initial remarks, please?
Thanks a lot, Dr. Charan Singh, and good evening to everybody. I shall use this opportunity to also take certain thoughts from the book which Dr. Charan Singh has been kind enough to review. It's on banking. Now, just to give you a background about who I am, I've been a corporate economist all through, but I've had the advantage of working in a DFI, a commercial bank, an engineering company, a commodity exchange, and now I'm with a credit rating agency, Care Ratings. I've always had this interest in banking, and I've been following what's been happening in the banking sector from 1987 onwards. That's when I started my career. And I'd also been a commentator on Indian banking from that particular point of time. Most of the time, I would say I do talk like an economist, since I've not actually been a banker. So even when I did work with the bank, I was more of an independent economist giving views on the markets and on interest rates, basically. But of course, I did catch on a lot on what commercial banking was when I worked at ICICI Bank. I think Mr. Sinor was our managing director. So working with him, of course, gave me a lot of knowledge about how really banking is done. When I decided to write this particular book, I thought, okay, I have a lot of knowledge, or at least I thought I had a lot of impressionistic knowledge about banking. As an economist, can I really put things together and create a kind of a storyline on banking? The first thing you do is that you ask whether data is available. And I think one thing which I don't know if everybody's aware of it, I think the Reserve Bank of India has a plethora of data on Indian banking. I think anything you want, any data point on banking, I think just go to the RBI website and everything is there in front of you. So I think this was not really a revelation for me because I've been working on this data all through, but right from 91 onwards, even the years before that, I think things have been put very well by the Reserve Bank of India for any academician, anybody wanting to study Indian banking. We get a lot of information, so that information was available. The second thing is, as this particular subject for today is about financial sector reforms, banking reforms since 1991, I think the first thing you normally do is you look at the Narasimhan Committee report. There were two reports which came, one early 90s and late 90s. And what is really amazing about the Narasimhan Committee is the kind of foresight which was there. I think that was a time when we didn't have any internet. And I think Mr. Narasimhan and the committee members must have put on a lot of work to know what's happening or what should be happening in the banking system. And almost any thought, any kind of an issue which we are discussing today actually was already discussed by Mr. Narasimhan in that committee report. So I think that's an amazing document, and I think it should be probably the starting point for anybody in the university who's doing something on banking. You should go into the Narasimhan Committee report, because almost every issue which we're talking of today is actually documented out there. Now, when we look at the trends in banking, I think between 91 and say 2020, where we are right now, I think lots of things have happened. And I think one factor which actually lots of people miss is that PSBs, public sector banks, are now today almost comparable to those of private sector banks. You look at any of the indicators, leave out the things like the staff, which may be on the higher side for public sector banks because of legacy issues. And even out there, we have seen that tremendous reforms have been made. If you look at public sector banks, number of officers to non-officers, which were there earlier, was a ratio 1:4. Today, I think we have more officers than we have the support staff. So there's been a lot of rationalization, which has been done in a very non-obtrusive manner. Because when we have seen private sector banks going in for rationalization, it's always a case of firing people. I think such a nasty thing has never happened in public sector banks. But over this particular period of time, maybe 2-3 decades, there's been this nationalization which has quietly happened without really hurting the labor in any particular manner, which again, I think is fairly remarkable. And even in case you look at some of the performance indicators in terms of growth in deposits, growth in credit, I think the public sector banks have actually acquitted themselves. They've done very well. And if you compare, so I don't want to take names here because I would be leaving out certain other names. So definitely, if you look at the top public sector banks, I think they have fared in a comparable manner to those of the private sector banks. In fact, among the private sector banks, I think while we always keep talking of privatization of public sector banks, I think the point we miss is that even among private sector banks, there are the good apples and not so good ones. And the commitment which was shown by a number of private sector banks was limited. So the very fact that we started off with a number of private sector banks which don't exist today, they were probably merged and then finally bought up by another private sector bank. So I think when we're talking in terms of having more banks, giving more licenses, I think the issue is really that anybody starting a bank should be having the long-term commitment to really serve the country, because you're not going to make money in the first 5 years, maybe 10 years. There are lots of regulation which is there in the country. There are lots of other social objectives for the country. We need to balance all these things. So what we have seen is that we get a feeling that some of the private sector banks which were set up earlier were out to create an enterprise, get a good valuation, and then probably sell it off. So we didn't have that kind of commitment coming from the from the people who started the banks. So they were sometimes industry houses, sometimes they were individuals, but that's the long and short of it. Now, that was one part of the trend. So as I mentioned, that today, while we try and say public sector banks are different from private sector banks, I would say generally, if you look at the progress over 25, 30 years, I think the public sector banks have fared very well. Maybe there are certain indicators which I will be talking about a little later on account of what I would say governance issues. And when I say governance issues, it's not really a case of something wrong with the people who are running the company, but because of the nature of a public sector bank, which is government owned. I think the moment you're owned by the government, you have to do what the owner says. That happens even for a private sector bank. We've seen that in some of the more controversial banks of late. But if you look at the public sector banks, that's the second set of issues which we need to really look at when we're talking of banks. But while we have changed the way in which banking is done, the ideology has really not changed. Okay, when I say the ideology, so today when we are talking of government ownership, there's no right answer to it. Does the government have a right to decide on how the commercial activity of a public sector bank is run? I think that's a very critical issue which has to be taken on, because when we're talking of the future of banking, and given the fact that public sector banks still have a share of around 60 to 70% of the entire system, do they have the freedom to operate the way they want to? I think when we were discussing slightly, I don't know if it was when we started this this particular conversation, but very often there are certain social objectives which are there for the government. This could be any government, so I'm not talking of a particular government A, it could be a particular government B, C. There are lots of social objectives which are there, which are implemented through the banking system. And these kind of obligations don't really lie with the private sector banks. They have to be done by the public sector banks. The public sector banks do it, something goes wrong. So for example, if you go back to the 2011-12 story, where there's a big infrastructure push given post-Lehman crisis, we had a fiscal stimulus, monetary stimulus, became cheap. We were asked to lend a lot to the infrastructure sector. Public sector banks have to do it, you do it. At some point of time, we realized that loans are going bad, and all of us take a lot of umbrage to it and say, look, what have the public sector banks done? Now, we say, okay, maybe there was something wrong with the management, but actually it's not a management issue. It's more of a case of governance issue, the ownership issue. I think that's something which we need to tackle, because even today, if you look at the way in which lots of these COVID-related programs have been structured, lots of them are towards the public sector banks providing support to whichever is the targeted group you're talking. I think unless we're able to practice, I think we're going to run into this problem again and again. And this is an issue which actually has to be taken up at a government level. I'm quite sure that even if I were a part of the government, I would also like certain social programs, certain economic revival packages to be implemented, and the onus would fall on the banks which I own. So it will be the public sector banks. But the whole question is that when we're talking of long-term sustainability of public sector banks, making them really viable and competitive in the market, we need to have a second look at this as to how exactly are we able to implement these kind of programs. So therefore, I feel that while we talk a lot about privatization, there's always a feeling that maybe we don't want to give up the ownership. The government doesn't want to give up ownership of the banks, because the moment you go below 50%, you become answerable to the shareholders. And at that particular point of time, you may not be able to say that, look, lend to the SMEs, restructure these loans, do a farm loan waiver. You have to do it. You have no choice. Farm loan waivers don't work for private sector banks. They work for public sector banks. As I told you, as an owner, you probably have the rights, so there's nothing wrong in it. So these are the kind of issues which I've also highlighted out there. And while somebody could be critical, saying that I haven't really taken a stance of saying what is right or wrong, the answer is really that there's really nothing right or wrong about it. But the only thing is that when you sit back and take offense to whatever is happening in the public sector banks, it may not really be a fair thing to do. Another part of ideology is that an issue which I think requires a lot of discussion, again, there's no clear answer, is about resolution of bad assets. Because if we look at the whole story of the IBC, I think the way it went through, the kind of turbulence which was there when the RBI came up with the first set of guidelines, they had to revise it the second time. The sense we get is that, but yes, there are both sides to it, because if I'm a power sector company and my asset is going to be taken to the IBC, and I lose control of it, why should I go ahead and make any kind of investment? That is as far as the borrower is concerned. But from the point of view of the bank, if you're making sure that things just get protected, things get delayed, then will my banking system ever come clean? So I think these are the kind of issues, I think, which are more based on ideology. I think it needs to be very serious discussion taking place, because normally the attitude is that, okay, we have gone past one particular leg of the IBC, so we found some solution. The RBI has come up with a second set of rules. And now the RBI has actually put the onus on the bank, saying that if you are not going to go to the IBC, you make higher provisioning, you make higher capital requirements. Okay, that's kind of a stopgap kind of an arrangement. But ultimately, I think if we want the banking system to really evolve, we need to have to assess as to are we actually going in the right direction. So if I want to have a strong banking system, I have to make sure that I do everything to make sure that the banks can recover their money. Because finally, at the end of the day, I think you're taking money from deposit holders. If you're not doing well, it's not the shareholders who are suffering, it's actually the deposit holders. And just think of the kind of write-offs we're having every year. I think it's a horrendous amount of money. So quite clearly, I think we need to be a bit mindful of this, and I think there needs to be wider discussion on this particular issue too. Similarly, I've taken up the issue of bank mergers. I think that's been another kind of subject where we have spoken of a number of banks being merged. But I think if you don't change the basic ideology in the governance structures, I think it's not really going to help much. Just adding up 3-4 balance sheets of banks may make the final capital adequacy ratio, the NPA ratios look better. But is this really going to help in future if I'm not going to change the way in which I look at these banks, the way in which I operate these banks? I think there are lots of things which we need to reconsider, I think, when we're talking of the future of banking, because these are the issues which have been sort of nagging us in the past, and they will continue to nag us in future. And whatever incremental changes we bring about in the system may not really work out the way we want to unless we're able to address this issue. And this governance issue is not just with public sector. I think private sector banks have their own set of issues. And we have seen very often in private sector banks, the CEO is just too powerful. You have a board of very good names. Nobody questions you, so therefore decisions are taken. Things go wrong, but the difference between private sector banks and public sector banks, unless it becomes too nasty, you don't have the 3 C's running after you. So when things happen in private sector bank, it's considered to be an internal affair, whereas when it becomes a public sector banks, everybody's affair. Everybody says what happens to the deposit holders' money. Then deposit holders put in the private sector bank, nobody says, look, what's happening to the deposit holders' money. It becomes more, I mean, the way in which the public looks at it, the way in which everybody looks at it is quite different. But I think the governance issues in all banks, I think that's something which even probably the Reserve Bank will have to talk it out with the government. I think none of us out here in this forum will be able to resolve it. It has to be done at the government and the RBI level. How do we actually ensure that things really smooth, go well with governance? Just concluding this, I think before we get into the other issues, I think the basic thing is that a lot has happened in the last 30 years. PSBs have actually done very well. If you remove this particular part on governance, it's a more deep-rooted issue, something which we will have to address. Otherwise, most of the changes which you're talking of will remain more peripheral in nature. And And given the fact that we're talking of 5 trillion economy, 10 trillion economy, we're talking of rapid growth. And I still feel that banks are going to be the mainstay of financing. It will not be the bond market. It will not be the DFI. It's going to remain within the realm of the banking system. Because we have seen that in the past, I'm just talking of this issue of a DFI. I've worked in a DFI. They were non-viable. The model was non-viable. That's why they were merged into their commercial bank. That's how the universal banking concept came through. We have seen certain infrastructure companies coming up, finance companies. Those models also haven't quite worked out. One has become a bank. The other one is still, I don't know what's really happening with the other institution. So just talking of a DFI, maybe in the next 5 years, if we're able to create a good plan, maybe they may work. But I think for the next 5 years, I think the onus will be on the banks. And whether or not we like it, the onus will be on public sector banks, because this business of financing infrastructure has to be done by the public sector banks. I think once you merge the banks, they look larger, they have a larger balance sheet, they'll have the wherewithal to finance, take on larger and longer term finance. So that's something which is bound to happen. So therefore, we need to get these basics in terms of ideology in place so that things move smoothly from now. Thank you.
And Professor Ram?
Yeah, I mean, Dr. Singh, thanks for that. Yeah, and of course, there's an echo here. Can you hear me? I don't know. I
Some
hear
disturb-
To switch off their.
Yeah, there is an echo coming in.
Yeah.
Yeah, I mean, I hear myself twice. Okay? I do not know. Are you able to hear me now?
Yes, we can.
Yeah, but it's slightly garbled.
I have a difficulty, but still I make do with whatever I have. Yeah. Of course, thanks for the opportunity, Dr. Singh. Okay, it's honor to be in this panel, especially considering the other two panelists. I think they are our doyens in the subject, and I'm pretty privileged. So when we have to talk about reforms, I mean, for me, banking in India, I would divide into two phases: before Christ and after Christ. Remember, 1991, as Dr. Kannan was saying, it's a watershed year. And to be honest, though I was in the industry from 1983 onwards, actually, 83 to 91 for me, banking was debit and credit. Nothing more than that. I used to think that way. Afterwards, I mean, the kind of changes that happened, I think it changed the way we look at banking. Now, I'm just trying to put sum up of my assessment of what had happened in the last 30 years. If I have to do an assessment, I would say it's a good sake. On a lot of parameters, our Indian banking system has improved. In fact, there is a dimensional change. But on one of the very, very basic fundamental parameter, I am saddened to say the government has hesitated to cross the Rubicon. Because of that reason, I guess something is holding back the reforms and the performance of the banking sector. And before I make any further comment, it's my duty to give you one background about me. I am more of a Thatcherite when it comes to markets. When I have a view, okay, maybe right, maybe wrong. I guess the business of government is not business, it's governance. So that's I mean, I have to give a kind of a caveat. So now, let me talk about the positive things that have happened. See, the Indian banking system has become stronger, it has become more transparent, and RBI has, in a sense, okay, used all that it can to make the banking system more robust. Okay, the stability of the financial system today, in my view, it's much better than what it was, let us say, 10 years back or 15 years back. And RBI has done phenomenal things. I'm just going to give one or two instances which I think RBI has done exceptionally well. RBI has taken care of the contagion risk by addressing the issues related to payment system, interbank market. In fact, today, if anyone watches the Indian interbank market, less than 5% is the unsecured or uncollateralized transaction. This is by, I mean, any definition, a phenomenal achievement. And of course, the payment system by bringing in RTGS, I think RBI has done this. And RBI has also done something more. I mean, the regulation making has become much more transparent. Communication has become much better. I still remember my interaction with RBI, very senior executive, when I was in the newspaper. I made a request to them, can we get copy of RBI's notification? The year is 1997. She said, that is a secret document. I said, how it can be secret when RBI is giving instruction to banks meant for protecting depositors' interest? She said, no. But today, RBI not only gives a lot of data, as Mr. Sabnavis was saying, it also, in a sense, I mean, does something we name collaborative regulation, where before it comes out the regulation, it is consulting the market, it is consulting the participants, and that's a very important thing to do. Otherwise, I mean, I was in RBI to dump the regulation on anyone. I mean, we don't care a damn. We didn't care a damn. We would come out of the norm and we would say, go by it. Today, I guess RBI first comes out with the draft regulation, hears everyone in the market, and then tries to improve that. And the way RBI has handled the market, I mean, I'm talking about regulation, is phenomenal. The kind of changes we have seen in the money market, debt market, and in recent times, even in forex market. I think we are, if I have to rank India, when it comes to financial market infrastructure, we are almost at the top. Okay, so these are the positive things about what RBI has done. The negative thinking, and when I say negative things, one is actually the drag that is there because of the government ownership of banks. Because there have been some observations from other two panelists, I slightly have a different take. If I use some of the major financial parameters, PSBs have been a drag on the system for years on. If I take, for instance, return on assets, I mean, the numbers of PSBs are nothing much to write home about. If I take ROE, nothing much to write home about. And still worse is on the NIM front. And that's still worse if I consider banks and PSBs have lower cost of funds. If you have lower cost of funds and if your NIM is much less, something else is happening. So I am not exactly convinced about the performance of PSBs. And I think there is also one discussion about social objectives. I think there's a mistaken notion in India in general. We can combine business objectives and social objectives. That was the error when we came out of the Air India. That was the error Indira Gandhi made when she went in for nationalization in two phases, because social objectives can be achieved even with 100% private sector banking. Because take the case of today in India, we are mandating banks to invest 18% in government securities. I don't care a damn about the ownership. In the same way, any social objective, if you make it mandatory for every bank, more important, if the objectives are meant for society, the burden of that objective should be on the fiscal balance sheet, not on the bank's balance sheet. When you open Jan Dhan account as a bank, I should be given commercial compensation. When I do government business, I should be given commercial compensation. If we say so, private sector bank buy with PSBs and do business. So I think a lot more changes in my view have to be done in the ownership and government's thinking. The last point before I hand over the mic. When this new government came to power, I'm talking about 2014, when Modi ji came to power. I mean, finance minister at that time announced something by name Indra Dhanush. I thought that was the first step the government is taking to privatize PSBs. But I'm not very happy with the progress on this front, because if this government doesn't gather the guts to do that, no other government would do. We are trying, this government has been tinkering with banking system and banking reform. We have to go by the model of what Margaret Thatcher did. So that is my take. So I stop here, and thereafter we can have conversation as you. I'm trying to switch off my mic. You can go ahead, please.
So we have had the first round of initial remarks. I just would like to flag a few issues, and I leave it to the panelists if they want to take any of those. One of the issues which has been touched is by Madan is merger, and the issue that has been touched by Professor Ramachandran is on the nationalization. My own view is, and I would like to have the view of especially Mr. Kannan, my own view is that nationalization which took place in 1969 and 1980, did it really serve its purpose? If its purpose was to take banking into the remotest parts of rural India, I'm not sure if it really succeeded in that. If its purpose was banking for the non-banks, I'm not sure if it succeeded with that either. So, was nationalization really required? Or, as Professor Ram has mentioned, I could have outsourced these activities, provided commercial rate, and had the whole banking sector do it, and maybe the results would have been different. The flip side of it is the privatization of commercial banks, the privatization of nationalized banks. So I would like to pose this question to the panelists, and maybe you would like to revisit it. The other issue, which is a burning issue, and again, Mr. Sabnavis mentioned about it, is the IBC. Now, is IBC the right way? NCLT was there. The haircuts which are done in IBC, the time stipulation, of course, is there, but are we really achieving success the way we want? Or is the bad bank the way, as Mr. Kannan explained a little bit? So I would like you to, three of you, to take this, and if you want to revisit it, and if you mentioned it, please. The issue which is burning, and all of us are super worried, should the government recapitalize the banks? And if so, should it be conditional, or should it be altruistic and benevolence? And the last point that is there, and if you wish to like to speak on, is the issue of the non-performing assets. They have been rising, and more of them have become recognized after the recognition of the whole banking sector balance sheet that was undertaken during the time of Governor Raghuram Rajan. And then the whole thing precipitated. So with this, I would like to go back to the panelists, and after I have your response, I then go back to open the questions for the floor. So in this, I'm going to go in the reverse order. Professor Ram, we'll start with, then we'll go to Mr. Kannan, and then we will go to Madan Sabri. Professor Ram?
Is it audible from my side?
Audible.
I get an echo here. Okay, maybe I will take up on the first topic you mentioned, nationalization. Of course, my view, okay, is that if I read economic history of India, the first wrong step was taken by EGROW because of his, I would say, infatuation with the Fabian socialism. We opted for a command economy. That was a mistake. In Indira Gandhi's case, I would not consider that as a mistake. It was a deliberate strategy for certain reasons. She nationalized, of course, 14 banks in 69. Then again, when she came back to power in 80, she, nationalized 6 more banks. And at the end of the day, when we had worked in nationalized banks, we knew what it was used for. It was used as an instrument for, I would say, benefiting the government or the party in power. Because I've had witnessed, I was a party to, situations where Jagannath Pujari would come to a town. I have to forcibly find beneficiaries and give money. So in my understanding, the agenda behind nationalization it's not something to much talk about. So now, okay, even if we take the objective being, we have to broad base the banking system. We have to have branches in remote areas, social objectives. All these things could have been achieved without opting for nationalization. I mean, in other countries, they did not opt for because US has. I mean, I think most of us know. I mean, if I take the 1990 data of US banking, they had more number of banks than what India had. And even now, if I just go by the number of banks, US has much, but they don't have a home bank owned by the government. The access to banking have been provided without taking over whatever the banks. That is point number one. And what nationalization did, I think, in my understanding, you create a set of institutions where the reward system is skewed, okay, and the management is, I mean, chosen not because of competence, because of other reasons. I'm not saying every bank chairman is not competent. That have because I have tracked Indian Bank. Any one of us was tracked Indian Bank in 90s. Why some XYZ was the bank chairman? So the bank chairman, they get chosen for other reasons, and they don't. I mean, they are accountable only to the finance ministry. So that they had been dancing to the tune of the finance ministry. So that is one aspect. So in a sense, what you remember, we also created one more drawback. We imposed so much of social obligations on the nationalized banks. They were forced to compete with the new private banks post 1992 with one hand and one leg tied. And that, in a sense, created an asymmetrical scenario where, I mean, SBI should compete with HDFC Bank, but it would not have the freedom of HDFC Bank. It cannot even, those days, was not even able to have the kind of technology which HDFC Bank was having, because I was there, you were there, in the banking system. Up to 1994 in India, we could not bring laptops or, I mean, PCs to branches. Unions were, opposed. So we created an asymmetrical wicket, and we wanted nationalized banks to compete with the private banks. And in the process, the price that is being paid is that we have one set of banks in India which are having suboptimal corporate governance, suboptimal management, and they are giving suboptimal performance. But I have to consider one thing. I have worked in SBI, I have worked in RBI. Some of the brightest minds I have worked with are in these banks. Okay, that means nothing to do with the individual, I mean, talent. Exceptional talent you find in RBI and SBI, for that matter, Canara. But you put a lot of restraints or constraints on them, and you don't give them reward for performance. So obviously, what they get is, I think, what we see today. So I think we have lost. I mean, a generation has lost an opportunity. I mean, Indian banking could have been much better. Of course, it is a counterfactual state. It's opinion, but we are actually dragging the PSBs. And my suggestion, the last word here is, my opinion is that I think when the PSBs are in the current shape, that is in the going concern format, they have to look at other options. I mean, the government, what the government did for Lakshmi Vilas Bank, the case of, I mean, with reference to DBS, we have to enlarge that and do it for a lot of other banks. Then the government would get a lot of money. And about recapitalization, in my view, is an accounting. Okay, accounting trick. Any one of us know what happens in the balance sheet terms, and I don't think you ever recap someone who is not going to meet a target, who is again going to come back to you next year. I think this is a bad culture we have introduced. Of course, I got more to say. I stop here. Others have theirs.
Mr. Kannan.
I think you have touched on a very important point. Almost, I would say, 50 years after the nationalization, and I don't think so. We can always say with the retrospective effect, hindsight, that it was a bad thing or a good thing. But if you have noticed during those times, if I recall, the private sector the erstwhile private sector banks who were nationalized, they were all held by a few people, and they were all very, very cozy with certain clientele, etc. And second thing is the reach to the rural areas, etc., was virtually not there. Almost most of the branches are all in the metros, a few maybe in the urban cities, urban localities, but otherwise the reach to the banks was not there. So that was probably one of the reasons. But as Mr. Ram was mentioning, the entire thing took a completely deviation, and this was used by many of the government to ensure that directed lending, he didn't mention loan melas or what he calls shamiana melas or whatever maybe the nomenclature is being used by different governments from time to time, and that way, it was virtually said you need to sanction 100 loans in 3 days. No person would be in a position to appraise a loan in 3 days unless it's a very simple loan against overdraft against fixed deposit. But I think all those things happened, and many of them went bad. But those are all one reasons why the nationalization did not really succeed. But otherwise, taking the banking facility to the common man was possible, and because otherwise it would have been totally out of reach for anyone to have a simple banking account. Of course, I would say the Jandhan, again, another reason why the nationalist banks were actually forced to do it, ensured that most of the Indian public are now having accounts. And now with the digital footprint, I think the opening of these accounts has actually ensured that more and more people started using what you call Google Pays or the payment systems. So I think nationalization has had its positives in the sense it made branches to be opened at rural areas. Even the people who did not know about the banking started applying to banks also. So you had people from remote areas of Bihar or remote areas of Odisha, etc., joining the banking system. Otherwise, it used to be the predominance of the four metros who used to be the officers in these banks or staff in these banks. And I think more and more branches were opened there. I remember, we were hardly around 4,000, 5,000 branches, even as late as late 70s. And then we increased about 10,000 branches, 15,000, and so on. So I think nationalization has had its services purpose. But as earlier, I think Mr. Ram or Mr. Sadnavis also mentioned, the governance is an issue which actually sort of clouded the entire issue. Instead of giving the freedom to the banks to do it, and then with some sort of a guidance saying that this will be done, almost everything was a directive. So much so that I think a couple of RBI heads have actually mentioned that they don't have much of a say in the PSB functioning because most of the say is done by the government officials. Even the appointments of the senior officials of the banks are decided by them. Not only decided, but decided with a lag. And any delay also affects the efficiency of the banking system. So a combination of various factors may say that the nationalization did not do well, but I think these are not the factors because of the nationalization, but because of other reasons like the governance, etc. And the capital portion of it, you're saying about a recapitalization. I'll come to that. But that's on the bad bank. I think bad bank, as the ARC concept is like a bad bank, So you have people who have got funds who will come and bid for the assets with a bigger haircuts and then expect to restructure the loan or and restart the entire activity. But over a period of time, we saw someone to game the system, and the ARC did not function properly. And therefore, they need for a bad bank. But who's going to fund the bad bank? So that is something which is a big question. Almost this question has been asked for the last 7 to 10 years and probably be asked for long more years. But bad bank as a concept, some people say certain countries like Malaysia and all has been successful, but then it has to be done at the current market value rather than on the face value. So if it's done at the market value, might as well have the ARCs. But then the ARCs have a problem of capital. They don't have adequate capital. So the issue is who is going to fund the bad bank or the ARCs, who in turn will purchase these assets. And of course, the sale to ARCs also is now under cloud because people are being questioned as to why you have sold at a particular price. So, like someone mentioned, the three C's overhang on the public sector bank also affected. On the issue of recapitalization, it is not a question of whether they should. Do they have any other option? Because if they don't do it, then technically the Reserve Bank of India will put them under the PCA, which has been there in many of the banks, and they will not be in a position to perform routine lending, even simple lending. Therefore, it is essential to recapitalize. But why it has to be recapitalized? Mainly because they are unable to raise funds from the market. Why are they unable to raise funds from the market? As someone mentioned, poor ROE, poor ROE. Why is poor ROE? Again, so it is not a single, simple, straightforward solution saying that you have to recapitalize or not. You have to recapitalize in case you want to get forward. But then, how do we turn around the banks to ensure that they start performing well and then they start accessing the market? Time and again, for the last 3 years, Indra Dhanush program or the subsequently, they have been, all the public sector banks have been told, please sell off your non-core assets. Please sell off the assets at whatever discount and raise capital. While some of them have been done, but they are unable to raise funds from the market. And believe me today, you ask any analyst, either in India or overseas, they will say, we are interested in banks, but private sector banks. If at all in public sector, at best, maybe one bank or two banks. But the others, we won't even touch the barge pole. It's unfortunate. Why? Because they don't see that these banks will become ROA or ROE positive and then start improving, and then the income goes up. Someone rightly mentioned that the cost of funds is low. But then, despite the cost of funds being low, the NIM is very low, mainly because that pricing of the assets, the risk-based pricing is not very much in tune. And therefore, that is also another issue, partly because of the governance. That's in the past, the nationalization, post-nationalization, there was a direct lending at fixed rate, 7%, 10%, 9%, whatever be the scenarios at different points of time. And therefore, they had no say in the matter, even though the cost of funds used to be 5-6%. They used to say, no, you have to lend at 9%. Therefore, although theoretically NIM was 3%, but if you take into consideration various costs, it could be a negative. That's it. On the NPA front, I think NPAs are a natural phenomenon of any banking. Anywhere in the world that will be bank. But today, it is ballooning partly because the poor financing, which I mentioned, also because of non-enforcement of contracts. So people have actually in 2011, 12, 13 have financed a lot of power companies. And the power companies had issues regarding the FSA or the PPAs, or even if the PPAs are in place and FSA is been, they are unable to enforce the contracts. So the legal system is also sort of not handled this properly.
Mr. Kannan, you have gone mute. You have to unmute yourself.
I can't hear you.
Am I okay?
Yeah.
Okay, sorry, no, I think by mistake I must have touched it. So the power sector, they have also been not paying the power producers on time, except for the NTPC, which has got a different kind of contracts. Most of the other power producers are in deep trouble, and therefore these are all issues which also extends why NPAs are going up in especially the corporate sector. While NPAs are going up in the other areas also, but they are all much controlled, and because of the widespread number of borrowers, you've got about a lakh of borrowers. Even if 50 borrowers, 100 borrowers, or 200 borrowers, the amount which is being lost is very small. And in quite a good number of cases, the recovery is quite okay. Whereas in the case of large projects, one particular project of 5,000 crores go down, and then you hardly are in a position to recover 6,000 crores after about 5 years and 10 years. That means your return is very, very low. So these are all the things which are there. It's a combination of various factors. I don't know whether I have touched all the 4 points which are there, but NPAs will rise, but it has to be under control. In the sense, you should be in a position to price the project in such a way that even if the NPAs come, that you have already recovered some portion of it well in advance. The differential between implementation risk and the post-implementation risk is absolutely not there, and that differentiation has to be maintained, and therefore the pricing is to be there. Governance and pricing are two elephants in the room, which most of us are refusing to identify and recognize.
Mr. Madan Sabnis.
Yeah, thanks. I think these are interesting issues which have been posed. Now, when you look at nationalization, I think we should look at nationalization from the point of view of the ideology which prevailed post-independence. I think at that particular point of time, rightly or wrongly, we felt that socialist kind of a setup was right. So that's how we had this business of nationalization which came in. Now, to my mind, I think if you look at, again, pure data, I think there has been a lot of expansion, maybe meaningless expansion of branches, because that's what we were supposed to do at that particular point of time. Banks were told that you have to reach out, so you reached out. So whether or not your branches were profitable or viable, you had to deploy certain amount of staff, set up branches everywhere. So I think this huge network of banks which we have today, I think a lot of credit goes because of nationalization where you're forced to do. Now, the problem in nationalization really is that it's become an intrinsic part of our policy, of our regulation. So, for example, if you look at this Narsimham committee, they very clearly said, if I remember right, that the priority sector lending should come down from 40% to 10%, I think they said, or 20%. But that's something which is intractable. I think the RBI has not changed it. Nobody wants to change that particular thing. So what we see today is that when nationalistic, or rather your socialistic principles become a part of my ideology, then we have too much of interference which comes from above. Now, one interesting thing is that I remember a couple of years back, it was mentioned at some level that in case public sector bank officials, the branch managers, did not meet certain targets of SME lending, their increments will be held up. Now, if I'm given such a kind of a threat from above, then automatically I'm forced to lend. And even I think when we have this saying that give a loan in 59 minutes, I think that's what the scheme is. Can we actually keep giving loans based on algorithms? The answer is actually no. But there is definitely certain pressure to say that we need to expedite giving loans to certain segments, and therefore we start giving it. Now, the problem here is that we keep giving loans, they turn to NPAs. The next problem is in terms of recognition. We don't want to do it. I remember in 2011-12, when we had those loans turning bad, we said corporate debt restructuring. Now, who does the corporate debt restructuring? The same banks who have given the loan. They will say there's some perverse incentive. I don't want to call it NPA. I'll call it a restructured assets. And all this had the regulatory blessings also at that point of time. And none of us felt it was wrong. Some of us felt it was nothing else but evergreening, because you say that the company is not able to service its debt because something was wrong in terms of the coal scam or iron ore scam, doesn't actually exculpate anybody from repaying the loan. So we have had this tendency to always say that when I have an NPA, I don't want to recognize it. So this kicking the can concept then suddenly balloons when you have a governor of RBI saying that, look, we need to have a recognition in a fair manner. You start doing this recognition, and then you say, why is it jump from 4% to 10% to 12%? Now, look at this particular situation now. We have lots of restructuring of assets happening. SME loans are being restructured. We're having one-time restructuring happening. So do we actually know what is the quality of assets today? So why don't we have a transparent system to say that, look, I call every loan which is not being serviced, whether it's COVID times or non-COVID, let's not try and put the screen in front of ourselves. Say very clearly it's 20%, but we can forgive it because it's COVID. Now, we're not doing such a thing. We're still showing that all our NPA ratios have come down to 7.5% or 8%. Now, maybe 2-3 years down the line, we'll suddenly realize it's not 3%, it's not 8%, it's 15%. And all of us will meet in this seminar and again say, look, what's happening to our banking system? Everything is gone for a toss. I think what is required is transparency, and we should admit that if I have a 20% NPA ratio today, it's perfectly all right because of COVID times. By camouflaging it in the form of restructuring, I think we are delaying this entire process. And I think this is something we should not do. So therefore, I think this FSR report of RBI is very good because it very indirectly tells us about the stress case scenario and tells us that the worst case scenario, my NPAs can actually be in the region of 14% or 15% is what they've said. And that's the number which we should actually take. Don't go by the number of 8%. Now, I think there's one thing interesting. I think I forget who said it, either Dr. Urjit Patel in his book or Dr. Viral Acharya. One of them had mentioned that why is it that every budget lays down targets for agricultural loans? Why should you talk about something in the banking sector? It is something being done by the RBI is asking banks to do it. So what's happened is that this entire business of lending to agriculture, lending to SMEs, which is a banking issue, gets a political overtone because it comes into the budget. Because the government is saying at the end of, and I'm not saying it's just the NDA government, you will go back to the UPA government, they also were doing it. So all governments have been trying to leverage lending to make sure that they have gotten a political advantage. So that itself puts pressure on the system. Now, for example, even if you look at this Atmanirbhar, what do they talk of? They say that 2 lakh crores of Kisan credit for Kisan credit cards. That's actually happening in the normal course of activity. But by making it a kind of a policy, there is some kind of pressure being put on bankers. Maybe Kisan credit cards may not be running into the kind of NPAs. But if you look at the overall way in which we're looking at the banking sector, I think this is the actual kind of a problem which we are having here. Now, when you're talking of recapitalization, I think whether or not we like it, if the government owns the banks, it's a responsibility of the government to recapitalize them. Now, you do it through budgetary allocations or you do it through recapitalization bonds, that's immaterial. But I think the fact that these banks are serving the government's purpose since nationalization days, I think it's the duty of the government to recapitalize them, just like in case of a private sector bank which is going down under. You need to get your resources, your capital from somewhere else. But I think we cannot really say that, look, this bank is doing badly, let's only recapitalize the good banks. That's not the right way to it, because I think all these banks have been serving a purpose of various governments, and therefore it's a responsibility of the government to recapitalize them. And last of all, when we're talking of this issue of IBC, I think this bad bank concept, yes, it's very pertinent. Who's going to own the bad bank? Is it going to be a running affair? Because if it's going to be a running affair, then everybody will say, let's build up NPS. Let me be a borrower. I will not pay the bank. The bank will have the NPS. We'll pass it on to the bad bank. Banks are anyway clean now because the bad banks are going to hold all the bad assets. So therefore, it's good for everyone. It's a win-win situation. Again, there's a purpose incentive being created. Now, we should remember one thing, that the reason why bad bank will not work if it's not owned by the government is, as I think Mr. Kannan had mentioned, how do you value the asset which you're selling to your ARC? Okay, why did the ARCs not work? Because if I'm a banker, especially if I'm a public sector banker, the loan is 100 rupees. If I want to sell it at 100, but the ARC will say I'll pay 20, I pay 20, tomorrow I retire, the CAG will come to my house, not CAG, the CBI will come to my house after 5 years and they'll take me to prison and I won't even remember what happened at that point of time. Therefore, the deals never took place. IBC, to my mind, is a very transparent process. It's an independent body. So unless your bad bank becomes a government organization, then you say let the government decide what the selling rate is. Only then will such a concept work. Otherwise, to my mind, bad bank through an ARC, there's an ARC is a bad bank concept. It's not really going to work. We will need to have a greater intervention coming from the government. Otherwise, I think IBC is probably the best bet for it. Thank you.
I thank you for your comments. Now let's open the floor, and Mr. Anand would like to ask a question. Can you directly ask, please? And others who want to ask a question, please raise your hand at the chat box. You can raise your in the chat box, and we'll come back to you. Mr. Anand, Mr. R.K. Anand, please.
Yeah. May I seek the confirmation, sir? Am I audible?
Yeah.
And to the panelists, I have a request. We will take a few questions and then we can answer them sequentially. It's already 6:43 and we should close by 6:55. So Anand, Mr. Anand, please go ahead. So we will have a question from Mr. Anand, then Krishnanand Tripathi, then Mr. Narendra, in that order. So yeah. Mr. Anand, please go ahead.
Right, sir. Thank you very much, sir. Sir, I have one question that as the panel was discussing, and I had been into the national level conferences for a long period in the career. This issue of financing the economic assets or the national assets in the shape of long-term infra projects has come to banking as DFIs were taken out and this long-term finances was on the balance sheet of the banks. So we got created and loaded with the assets which were of the large amount. amount for a longer period, and we kept passing on through the cycles which were uncertain over a period of 20 years, 25 years. It is the asset side. Okay, fine. I don't have any immediate hope of getting it resolved on the asset side because the ownership of the public sector bank in India, a very high proportion is of the government itself. So I don't think that this asset financing will stop so early and so fast. Now, when I look to the liability side of the balance sheet of the banks, particularly the public sector banks, out of my experience of sitting in ALCO and the capital planning committee and raising funds from the market for the banks, I look at the liability side that we, the banks in the public sector, I have a question to the panelists that we have the scope of being allowed by the government, which is the largest owner of the public sector banks, to raise long-term funds through bonds which are tax-free, having tax incentives, and not depend upon financing of long-term projects just on the basis of retail deposits. When I feel proud that I have CASA of 42%, 45% in my balance sheet, how can I be proud of financing the project of say 20 years? So this sets the serious trouble which we read in the banking management in the top level global institutes, that how to manage the banks effectively, the asset liability management. So here we get asset liability mismanaged, which can be corrected for the time being through liability support from the government. This is one issue. The other issue, I just pass it on to the panelists. Second issue is that I have seen the instances that the public sector banks have gone deep into the loss because they were positive on the operating profit, but the provisioning exceeded the operating profit in the years like the current one and the earlier economic slowdowns, and we resulted into net loss. Now, sir, even then in those years, I have seen with my own hand and planned for the payment of income tax to the government. So when I come to the line below the operating profit, I am charging the tax on the operating profit. Why this simple thing cannot be done and sanctioned by the owner, which is the government itself, in the budget? And in the coming budget, we can take these 2 points for the consideration of the government as an immediate resolution for this hardship of the banks. So these are the 2 questions came to my mind.
Let's have a question from
Sir, I have also my question.
Yes, please go ahead. Followed by Mr.
My question is to Mr. Sabnavis and Mr. Kannan. Budget is round the corner. What do you expect from Finance Minister Sitaraman for the banking sector in this budget? And RBI has recently said that they are open to idea bad bank. Do you think that this is the right time for the government to announce its intent in this budget about the bad bank?
Mr. Narendra, please.
Yeah. Thank you, Dr. Charan Singh and all other panelists. This is a very good review of the banking from the 1991. My one question is, normally the performance of the bank in terms of NPA, I want to ask Madan as well as maybe Kannan also, that it is on the reflection of the economy. Normally, like some time back on the boom period, the banks were giving loan to the infrastructure and other projects because the rate of growth in the GDP was around 8.5% average. That came down to hardly 4.5%. And even now, the government has a planning of pipeline of 111 lakh crores of infrastructure. And maybe for some time, we are not sure of what will be the level of GDP growth. So that is the one issue. Second is, I found that other than some of the bad borrowers, there is also lack of private equity. In fact, the private equity is not coming enough. And sometimes they have been using the bank loan itself as equity. So this is the one issue which is to be taken care. And third issue, of course, Madan was also mentioning, that one side the credit to GDP ratio of India is not up to the mark, hardly maybe 50-60%. Globally, it is sometimes maybe even 130-140%. So we need a more number of banks, and that too also specific sector based or specific purpose related, other than the one now currently likely that the establishment of development finance institution. So in that regard, one side we are making the merger of the bank maybe to become stronger, but at the same time, whether public or private, we need more stronger banks to come. So these are my some of the questions. Of course, as far as another important thing, I do agree that the nationalization of bank from 1969-1980 has done quite a lot of work, and whether in the inclusive growth or in reaching to the rural area or in implementing the government policy, which I feel that government policies are also a source of opportunity for the bank. In fact, even some of the new generation banks have taken much advantage of the government scheme on the inclusive growth or financial inclusion or in the direct benefit transfer in most of the things. So how do we take it on the positive side? That is to be seen, and we must take advantage. Even in Jandan Yojana account, 40 crores account, now more than 1.3 lakh crores of balance, and 60-70% is operative. So these are my some comments out of that, and all the panelists have spoken very well, and I appreciate them.
I would request Mr. Kannan to go first, followed by Mr. Madan Sabnavis, and then Professor Ram will have the last word. So, Mr. Kannan, please.
Thank you, Dr. Singh. See, I'll just go through some of the issues as I've jotted down. First thing is what Mr. Anand has mentioned, that there is a asset liability mismatch. But even in other countries, CASA is always considered as a very stable deposit. They look at the runoff in the last 5 years or 10 years and then find out what percentage of the CASA actually goes off, whether it is a stable kind of deposit. I've seen in many banks, the deposit, the CASA ratio, especially the savings bank, is around 35 to 40% permanently over a period of so many years. So some portion of it can actually be given. And in fact, they are all very, very low cost funds. So from that point of view, there are some issues. But the issue is actually coming if you are going to finance a project with uncertainties and where there is a delay in the execution, and that is not being properly priced. So it's not one issue regarding the asset liability mismatch is there, but that's not such a big unsurmountable scenario, because as I told you, we've got some stable CASA deposits. Some of it can be given. But another issue which has come is many of the banks, someone mentioned about mergers. We have all the 28 banks financing projects, with many of them not having very good CASA ratios. Some of them had 15%, 20%, 25%. And they had actually taken bulk deposits to finance it. And then they got into a vicious cycle, in addition to the fact that the NPS were in trouble. And once you are into the vicious cycle of taking bulk deposits, then you have to ensure that you continue to extend that bulk deposit, and that maybe at higher rates. So that was an issue. So the merger ensures that you have some very 5, 6, or 7 strong banks. I also have a concept that, instead of having all the banks doing all the work together in the same way, 5 to 6 banks could become what's called the universal bank, which does all kinds of activities, including project financing. 5 to 6 banks could be asked to do only loans up to, say, 5 crores and 10 crores, and therefore do the activities which hitherto now the MFIs or the what they call the small finance banks are doing. And therefore, the risk is actually dispersed as a higher return, and also they have a feet on street, and they are in a position to contact the borrowers. Whereas those banks should not be financing the infrastructure. The idea was put that the government should permit tax-free bonds to be done. I think tax-free bonds is a big hole into the fisc of the government, and we have seen that it is so popular that virtually everything was oversubscribed 200% or 250%. And even a few years ago, and I think 2014 or 15, again they were trying with the idea, but then tax-free bond as such is a big loss to the exchequer, and I think they may not do it. But some sort of a combination could be given to the proposed DFI, where they can have a semi tax-free, in the sense saying some 50% of the interest should be tax-free, or some the issuer can be asked to pay a portion of the tax. So that something can be given. But yes, you're right. We need long-term funds. But I don't think that is one of the issues, but not necessarily the main issue why the problems of finance. The issue is also of monitoring of these projects. And regarding the taxation, basically the tax is always on the net profit, but the net profit you have to add back the provisions which has not been written off. The provisions, the entire provisions which are there are not permitted to be permitted by the income tax rules to be exempted from tax. You're right. Therefore, even though some banks have a loss, they end up paying tax because the entire provisions is not permitted as an exemption. Therefore, that is the scenario. So, and if that is changed, then maybe many of the banks will not pay tax at all, and maybe some rethink has to be done. But the idea was that you write it off. If you write it off, then you're permitted to set it off and then pay lesser tax. Then I feel in the budget, I think there's a question about the budget. I feel the budget should be more about how kickstarting the economy, not necessarily asking the banks to lend. It has to be that how do we incentivize the industrialists, the people to set up new units, etc. Some sort of a benefit by way of some tax relief or some incentives in certain locations to start increasing the exceeding the enhancing the capacity expansion should be done. So because we have not seen this in the last 3-4 years, there's been a lot of talk about fast tracking infrastructure. I think that has to be super fast tracked, and that could be something which will kickstart the economy, and you will have a complete flow of the funds to the other sector. Bad bank, I think we have already spoken considerably about it. If it is set up, then it's going to be a big issue regarding at what price it is to be done. And as I think Mr. Sabnavis mentioned, NPA is not going to go away, so it has to be there, and therefore the bad banks will keep on going. I would request the others to speak because I think we are already running out of time. So the other speaker.
Mr. Madan Sabnavis.
Yeah, very quickly, I think they're just 3 minutes, so I'll just make 2 points. See, one, in the budget, we are expecting there'll definitely be an allocation made for capitalizing banks. We're looking at something around 35 to 40,000 crores. The mode of capitalizing will, of course, be interesting. The second thing is, yes, definitely, I think there will be some plan to set up a DFI. So that is something which is very much on the anvil. So that's what our expectations from the budget are. And in terms of NPA, I think what Mr. Narendra pointed out is very much true, that when the economy slows down, NPAs tend to increase. And today, when the NPAs are not showing an increase and the economy is slumping, I think this actually sort of raises the red flag that in future we could be expecting the NPA levels to go up. But there's a direct correlation between the two. Thank you.
Should I chip in? Hello, Dr. Singh.
Yeah.
Are you able to hear me? Should I chip in?
Yes, I can hear you.
Point number one about what Mr. Anand was saying. Of course, in my view, and any one of us, I guess, would agree, I suppose, banks by definition would have maturity mismatch. So that's something I think inbuilt into their balance sheet. So that cannot be a reason why a bank should not fund long term. Because if you are a bank, you presume your average, I'm talking about on the liability side, maturity could be 3 years. On the asset side, if you get into project financing or other kinds of long-term financing, it can be 7 or 8 years. But that's something that can be managed, okay, because that's part of banking anyway. The issue is not about even maturity mismatch. It is about pricing. It is about expertise. That is one issue. The second thing is that if we go by what Mr. Anand was saying, we would give the concession to bank to, come out of the long-term bonds. We are actually now, that means making banks back into DFI days. I think that's something I would find it difficult. And another thing, that all these issues crop up because we missed the bus as a country when it came to deepening and developing the corporate bond market. Because if you see across economies, India is one of those economies where banks dominate. And that's the reason the entire burden of carrying the economy is on them. And of course, thankfully, in the last 3 years, SEBI has come out with certain prescriptions, I hope, that get acted upon, under which, corporates are supposed to source at least 25% of their incremental funding requirement from the bond market. I think we have to look at, the bond market and try to strengthen that. Instead of, again, DFI, if it comes in, we'll be revisiting 1980s. DFI in today's market, I do not know, okay, how good they would be. Then the other point about, I forgot what the issue we were discussing, NPA. The NPA, I think any one of us would know banks are index of the economy. If you happen to be the index of the economy, your fortunes will swing with the economy. But the only point of difference I would have is the economy is the same for every bank. If I take the gross NPA figures of the banking system today, I'm talking about RBI's grossly understated NPA. RBI's financial stability report is a joke because read the foreword. RBI says everything is obscure now. If everything is obscure, how do you come out of the data? I do not know. Anyway, even with that data, when I see the numbers, the gross NPA for the PSBs with the obscured number is 10.3. It is for the private banks, it is 5.5. For the foreign banks, it is 2.3. And net NPA for the PSBs, going by the RBI's obscured data, is 3.7. And of course, for the private banks, it is 1.5. So I think, man, you are the same economy. If your numbers are worse than some other bank's number, I guess we have to do as PSB. We are from PSB, some of us, we should do a bit of introspection, and the government should do a lot more of introspection. The economy is the same for everyone. The expertise is not the same. That is one thing. And the incentive system is not the same. And I think that could be the reason why there is a drag on the performance of PSBs on some of the very important metrics. Because when I see the NIM figures, I get disturbed. NIM figures being pathetic when the cost of funds is very minimum for a particular bank group, that means something is wrong. So that's my take. As far as the budget is concerned, I have only one request, one word or one sentence. I want the government to be truthful in the budget. I think truth is a predicating factor when you prepare budget. I hope this time the government does that, because last time the government knew the scenario, it actually, remember, did not react to that. Last two budgets, the government made, in my view, one mistake. But slowdown was obvious to everyone, including the government. I'm talking about 2019 budget, where the government did not want to recognize, came out the normal budget, focusing on fiscal deficit. Within 3 months, Ms. Sitharaman had to announce a lot of corporate taxation benefits. And that's an obvious thing. Second, in the previous budget, that is January 2020, the budget became irrelevant because of pandemic. And even in that budget, I think the government was obsessed with, in my view, fiscal rectitude. Fiscal rectitude is important. This year, if the government were to focus on fiscal rectitude, I think that's, in my view, a wrong way to go about. Fiscal deficit, I think, is not the issue to focus this year. Government should spend, spend, and spend. And of course, I have my wish. I hope it will gather the guts to sell some banks, but it won't. That's my wish, but it won't. Even, what happened to Life Insurance Corporation, we know. It's easier to make grand announcements in budget, but I think we have to act upon that. Let's see what happens now. That's there I stop, okay?
So I want to thank each one of the panelists who have come and shared their thoughts with us. And I want to thank each of the participants for having spent time with us. And some of the participants have asked questions. I want to thank them. Next Friday, we have Professor from Harvard Kennedy School speaking to us, Josman Ricardo, giving us a post-COVID global situation. I would request each one of you to please join and take advantage of Professor Josman Ricardo's presence with us. Thank you so much, and see you next week. Thanks.
Thank you.
And thank you, okay, all of you. Thank you, Mr. Kannan.
Thank you for being a
Thanks a lot.
participant. If I want to